This is BankCents, the podcast that makes sense of all things banking. If there's something you don't understand about banking or finances, you're not alone. Our industry experts are bringing you informative and enjoyable conversations that break down bank jargon and dive into hot-button financial topics. And now, BOS, a community bank located across Illinois and Missouri, presents BankCents. Here's your host, Gregory Marantz.
Welcome back to the BankCents podcast, the podcast that makes sense of all things banking. I'm your host, Greg Marantz, Senior Vice President here at the Bank of Springfield, and I'm excited today to bring you part 2 of our 3-part series on financial planning. Today, we're going to talk about financial planning in your 30s. Hopefully, you've been able to listen to our previous episode, Financial Planning in Your 20s, and I'm excited today to bring back our guest, Greg Pettys, our Vice President of Advanced Markets. We're excited to have you on again and dive deeper in again to financial planning. And this time, we're going to move on to our next step in life, and we're looking at the 30s. But before we dive into that, I really want everyone to take into consideration that even though this is the plan we're laying out, sometimes life doesn't go to this plan.
Exactly.
So because we're telling you this is what's going to happen in your 20s and 30s, it may not happen to you that way.
Exactly.
So make sure you're taking that into consideration. And these are just tips and tricks at every stage in your life to help financially plan for your future.
Good. As you said, life is just a journey and there's constant change. So by the time you hit your 30s and the kids have come, it's time to sit down and reevaluate goals.
Yeah.
The goals we had in our 20s, we've accomplished many of them, but there are some that are layered on when we have children and so forth. So what I like to do is categorize goals into needs, absolute gotta have, wants, and then wishes. Let's say the bucket list. And in order to do so, I have these priority cards. And there's 27 of them here, but save for retirement, minimize taxes, manage your investments, Social Security, business succession, protect the assets, estate planning, education funding, managing my debt, and other. And then what we do is we place these in front of the couple. Each has their own deck, and they prioritize these from 1 to 10, and then they compare. And there's a lot of discovery that goes on.
Sure.
I didn't know that was so important to you. How do you feel about that? Well, how come this is not at your, and there's a lot of good interaction and reviewing goals.
Mm-hmm. Yeah. And if you remember from our previous episode too, this is something we talked about, is setting up your priorities and what you want to prioritize at this stage in your life. And I think that's a phenomenal exercise to do. And I'm taking mental notes right now because I am in my 30s and have started a family. So it's definitely a conversation that I know
to revisit.
Yeah. That's great. And I think that's one thing that we continue to try to impress upon our listeners too. It's just having that discussion, that first step to planning will go a long way for your future.
Sure will. And one of the goals that first jumps out in the 30s so often is education funding.
Sure, yeah.
For children. Mm-hmm. And it's never too early to start. There are a lot of great vehicles like the 529 Education Savings Plan, the Roth IRA, and others, UTMAs and UGMAs, Uniform Transfer to Minor Act, Uniform Gift to Minor Act. These are custodial accounts for your children. But it's never too early to start. And not every child wants to go to a 4-year traditional education. Mm-hmm. And, quite frankly, not all children really need to or want to.
Sure.
And so having those discussions early with your children about their goals and about their dreams and then taking a look at their skill set and where you think that they could maybe have the maximum leverage in education. It could be a trade school, could be military, could be a 2-year certificate or a designation that launches them into their career. And then, of course, the 4-year route.
Yeah. And I think that's the big thing is having that discussion. I'm a product of a local community college. I did that for 2 years and then moved on to a bigger 4-year university. And I think a lot of the time you see these 4-year universities and they're incredibly expensive. Oh. So is that the right fit for your family?
Yeah.
Is there potential that you could get scholarship money? Those are factors you all have to consider.
And to that,
in making that decision.
The scholarship grant, whole arena is so important to have knowledge of the FAFSA, that federal, federal document, the free application for federal student aid. A couple of times, there's been clients I've helped that did not realize that the FAFSA is going to look at your financial situation from the year before the year that your child's going into college. So let's say when I'm October the 1st, when the FAFSA opens every year, you go online and you start clicking around and you'll find they want your tax return. If I'm doing it this October, they want my 21 tax return.
Okay.
So there are 4 asset classes that don't pop up on a FAFSA. These are some things we work with our clients in 2 years in advance to make some changes. And those are equity in your home, the cash value of life insurance, annuities, cash, and qualified retirement plans. Let's define that. IRAs, 401ks, 403bs, SEPs, all that pre-tax retirement money, that doesn't count.
Yeah.
So if people, let's say, had some cash just sitting around that will come up on the FAFSA form, they might want to look at this 2 years in advance, maybe using it to pay down some debt or increasing their 401 contribution, or putting more equity in the home. Okay. These are some FAFSA secrets, we call them.
Yeah, and I think as you're in your 30s and then your 40s and even in your 50s, that educational planning side of it is going to only be bigger and bigger as college gets more expensive. Sure. And also, I mean, you have some people out there that are paying for private high school or childcare as well. Right. All those different stages of life for your children, they're going to cost money.
And Greg, the 529 just became more valuable. I call it the Swiss Army knife of financial planning. Mm-hmm. See, you use it for the retirement or use it for education. Well, let's say you've put too much into your 529. Your child didn't go to Harvard or Yale or University of Illinois, but instead they've decided to do a trade school, or they joined the military, or they got a scholarship. Now, under the Secure Act 2.0, you can take that 529 that was designed for education. Now you can move it up or down the family tree. Any child, sure. You can move it to any other child or yourself to go get another degree. But powerfully, you can now convert a 529 up to 35,000 of it into the Roth for that child. Wow. Think about it. Yeah. Let's say an 18-year-old finds out they have a full ride, don't need your 529. Now we could take up to 35,000 of it, put it in their Roth for the next 30, 40 years.
Wow, that's great.
It really is.
Yeah, and just for our listeners as well, if you're not familiar with what a 529 plan is, it's a college savings plan that you can establish for your minor children. Exactly. You contribute to every year, or if the grandparents, instead of getting a toy that will probably be given away in a couple of years, exactly, they can give towards the 529 to help fund for their college education.
It's a great tool for grandparents to do gifting.
Yeah. And that's one thing I definitely would encourage people. If you haven't opened a 529 for your child, any amount that you can put into it will go a long way in the future, as that can, compound and start to grow and grow.
It sure will.
So I know the last item we really wanted to touch on is something we touched on in the previous episode a little bit, but we wanted to get into a little bit more. And that's really evaluating life insurance again, and then disability income as well.
At age 30, Greg, incomes are starting to increase. And everyone's depending on those incomes. The likelihood of dying in your 30s is much, much lower than having a disabled, event. Mm-hmm. If you're sick or hurt and you're unable to work, you're like that money machine. Let's say it's in the basement. It's been producing $100 bills and it shuts down. What are we going to do now? Well, we should have considered insuring the machine. Mm-hmm. If I had a machine like that in my basement, I'd probably put an electric fence around it. I don't know what I'd do, but I would, we're the machines. Every wage earner in the family is a money-making machine. And so check out your group DI. Make sure you have your group disability income insurance in place. But realize that won't go with you, if and when you change careers or change locations. Yeah. It's good to have a permanent DI policy that gives you a multiple of your income, a percentage of your income, with a certain elimination period and a certain benefit period. You can price that out. You can actually wrap it with your group term, group DI. Yeah.
And when you say group DI, that's referring to, your employer might offer it as part of your benefit plan or benefit package wherever you work.
Often they offer short-term and long-term DI. Yep. Take advantage of those, but don't just depend on those, because by the time you move, you might be having pre-existing illnesses, or you might be uninsurable. You want to have something that you can lock in and take with you.
Mm-hmm. Yeah, and that's the one thing to know for our listeners is wherever you work too, when you have that open enrollment period, make sure you're looking at that short-term and long-term disability. And if you're not enrolled in it, it's pretty cheap to enroll in. Make sure you enroll in it, because if something, God forbid, were to happen to you, it will be there as a backup to help, support yourself and your family in the future.
For sure.
Yeah. And so I'm glad we really touched on that too, because I think that's something that, as you are doing open enrollment with an employer, you might get a little bit overwhelmed when you look at health insurance and all these different costs.
Yeah.
So it helps you key in on some of those really important items that you need to make sure you're looking at.
Greg, I'd say disability income insurance is the most underutilized financial planning tool for 30-year-olds and 40-year-olds.
Mm-hmm.
Yeah. Mm-hmm.
Yeah. And when it comes down to it, it's just trying to plan for the future and plan for any event that you could, potentially plan for.
Yes.
And obviously, as, we encounter that future, you don't know what's to come next, but all you can do is, do the best you can with the information that you have.
Yes.
I really want to thank you for coming on today and talking about financial planning in our 30s. Once again, hopefully you've been able to listen to part 1 of our series, Financial Planning in Your 20s. And hopefully you'll be able to listen to our third part, Financial Planning in Your 40s. The one thing I really want to impress upon our listeners today, too, is it's never too late to start planning. And there's never a better day to start planning than today.
Take a step. Don't be overwhelmed. Take that first step. You'll feel better.
Yeah. Don't be afraid to ask questions.
Exactly.
So any question you might have, you might think it's a stupid question, but it's not, because it's for your future and for yourself and your family's benefit.
Yeah.
So I really appreciate you coming on today. I think we really were able to pass on a lot of information to our listeners. So thanks for listening to the BankCents podcast. Until next time.
Is there something about banking that doesn't make sense to you? Submit your questions to us on Instagram Messenger or by email, bankcents@bankwithbos.com. Or if you're watching this on YouTube, comment below. We're happy to give you our 2 cents on a wide range of topics. Thank you for listening on Spotify, YouTube, or wherever you get your podcasts. And please leave us a 5-star rating and review so we can continue to bring you more educational content. Thank you for listening, and we hope you join us on the next episode of BankCents.